Welcome to another Iron Financial Explainer, where our absolute mission is to help you forge a stronger portfolio and cut right through the current market weakness. Today, we're taking a hard look at a legacy asset that has literally been a staple in dividend portfolios for decades. We are talking about the telecom giant Verizon. Now, historically, telecoms own the literal pipes of the modern economy, which makes them highly defensive plays. But let's face facts, the market environment right now is absolutely brutal. Rates are shifting dynamically, capital is incredibly expensive to access, and pretty much everyone is asking the exact same question about these legacy capital-intensive beasts. Are we looking at a durable, ironclad asset to forge your portfolio with for the next decade? Or is this just heavy lifting for no real structural gain?
Because let's be totally honest with ourselves here. Looking at the telecom sector recently has felt a whole lot like trying to catch a falling knife. We've got to establish the central debate right here, right now, before we even look at a single data point. Is Verizon's recent Q1 2026 performance a solid, undeniable foundation for investors? Or is this massive company going to crack under its own weight? A lot of retail investors get lured in by big names and big payouts, only to realize they've stepped right into a classic value trap. And for those of you newer to the space, a value trap is exactly what it sounds like. It's when a stock looks incredibly cheap on the surface and offers a massive, tempting dividend, but the underlying core business is actually deteriorating from the inside out. It's like buying a house with a beautiful, fresh coat of paint, only to find out the foundation is completely eaten by termites. But before we assume the worst and throw the baby out with the bathwater, we absolutely need to look at the tangible, undeniable rewards shareholders are getting paid just to hold this stock while management executes their turnaround. Boom. Look at that number, 6.1%. That is the massive dividend yield Verizon is currently paying out to its shareholders. And let me be perfectly clear, this isn't some flash in the pan, artificially inflated yield designed to trick you. No way. This is backed by 20 consecutive years of dividend increases. We are talking about 2 solid, undisputed decades of management prioritizing returning hard cash to the shareholder. In a market where high-flying growth stocks are swinging wildly and giving everyone heartburn, a 6.1% yield is exactly the kind of income-generating power that acts as structural reinforcement for your portfolio. Okay, 20 years of consecutive increases is objectively impressive. I will give them that right now. Like we said, it's a really nice, shiny coat of paint on the building. But as a disciplined investor, you always have to ask, what is actually holding that structure up? Because when I put my market skeptic hat on, look past the dividend, and examine the actual foundation, I see something that should make any sensible, risk-aware investor sweat right through their shirt. $130.1 billion. That is Verizon's net unsecured debt as of the end of this first quarter. Let that staggering number sink in for a second. We aren't just talking about a corporate mortgage here, we are talking about literal nation-state levels of debt. You have to aggressively ask yourself, is that 6.1% yield really safe when a company is dragging around a $130 billion anchor? Because when it comes time to refinance that unsecured debt in a shifting high-rate environment, the new interest rates are going to eat them alive. That kind of leverage creates incredible, dangerous tension on the balance sheet. The debt is heavy. There is zero denying that. You simply can't hide a number that big. But listen, debt is only a trap if the company lacks the structural power to service it. We need to drill down into the actual earnings, the real operating cash flow, to see if the structure can actually support the weight. And that officially starts our drill down into the Q1 2026 financials. CEO Dan Schulman laid out a very bullish foundation on April 27th, claiming that Verizon's turnaround isn't just progressing, it is actively gaining momentum. The core of his strategy is highly focused. He's pivoting away from chasing cheap, low-margin growth through crazy promotions and instead focusing purely on premium customers and reclaiming structural market leadership. But hey, talk is incredibly cheap. Here on Iron Financial, we absolutely do not buy the narrative until we see the numbers to back it up. So let's pull apart the steel beams of this quarter and see what they're actually made of.
Let's do the heavy lifting right now. Look directly at the bottom line growth. We are comparing the Q1 2025 adjusted earnings per share of $1.19 directly to the Q1 2026 adjusted EPS of $1.28. That represents a 7.6% growth rate. Now, why does this matter so much? First, for anyone needing a quick refresher, earnings per share, or EPS, is the ultimate indicator of a company's profitability on a per-shareholder basis. It's essentially the total profit divided by outstanding shares. And a 7.6% jump, that is the highest adjusted EPS growth rate Verizon has posted in over 4 years. For a mature, legacy telecom, a company that's essentially a massive industrial utility, to accelerate its earnings at that velocity is a massive indicator of structural strength.
Now, higher earnings per share is definitely a good sign on the surface, but you and I both know companies can sometimes engineer EPS with aggressive share buybacks and financial engineering. So we have to ask, where is the actual organic business growth coming from? Well, it's coming right from the top line. Verizon brought in $34.4 billion in total revenue this quarter, which is up 2.9%. But here is the absolutely crucial point. The profit engine underneath that revenue is running hotter and far more efficiently than before. Consolidated adjusted EBITDA grew by 6.7% to a record $13.4 billion. Now, EBITDA is a heavy financial acronym, but it's simply the raw operating cash the business generates before the accountants and the tax man get involved to complicate things. That growth pushes their EBITDA margin to 38.9%. That is a record margin level for the entire company. They are quite literally forging more profit out of every single dollar that comes through the door by stepping away from low-margin, highly promotional activity. And you know what? The operational turnaround is actually showing up right on the consumer side too. Plus 55,000 postpaid phone net additions. Now, to the untrained eye, 55,000 might not sound like a massive million-user blowout, but context in this sector is absolutely everything. First quarters are historically brutal for telecom due to post-holiday churn. People cancel lines, switch carriers, the whole shebang. And remember, postpaid customers are the holy grail of telecom. These are the sticky, reliable users who sign contracts and pay a hefty monthly bill, unlike prepaid burner phones. This is the very first time Verizon has generated positive first-quarter total postpaid phone net additions since 2013. They literally broke a 13-year losing streak. Add to that 341,000 broadband net adds, bringing their total broadband base to 16.8 million, and you've got serious, undeniable volume growth happening here. But ultimately, it all comes back to the structural integrity of the cash flow. Free cash flow is the absolute lifeblood of this company. It is what pays that massive 6.1% dividend, it's what buys back the stock, and critically, it is what pays down that huge debt we talked about earlier. In Q1 2025, they had $3.6 billion. In Q1 2026, they generated $3.8 billion. That's a solid 4% year-over-year increase. And the forward guidance? Management is targeting a massive $21.5 billion in free cash flow for the full year. Make no mistake about it, this massive free cash flow is the only thing acting as a shield against that $130 billion debt anchor. This isn't just a business, it's a cash printing machine. So how exactly are they expanding those margins to generate that massive cash shield? By forging extreme efficiency. Management is actively targeting $5 billion in operating expense reductions by 2026. And they aren't just doing it by firing people and turning off the lights in the break room. They are fundamentally modernizing the structure. They are using AI to autonomously resolve 85% of network issues, which alone has already saved over $200 million in energy costs. Plus, the recent Frontier Communications integration is on track to deliver over $1 billion in run rate synergies by 2028. And by run rate synergies, we just mean permanent built-in cost savings from eliminating redundant corporate roles and overlapping network infrastructure. This is becoming a lean, mean, increasingly optimized machine. And this right here is where the bull case absolutely cements itself. Look at the sheer confidence of management. Keep in mind, Verizon willingly absorbed a $1.1 billion hit in severance payments during this quarter as part of their restructuring. That is a massive, painful expense to eat. Yet even after taking that hit, they flexed their strength and actually raised their full-year 2026 adjusted EPS guidance to between $4.95 and $4.99. That is up from their prior 4 to 5% growth expectation. Listen to me, you do not raise guidance in this current macro environment unless your foundation is rock solid. Okay, hold on a second. Let's hit the brakes. Because my job on this explainer is to make sure you don't just blindly buy the corporate hype. We've painted a beautiful, sunny growth narrative so far, but every structure has stress points. It is time to pivot this analysis and aggressively stress test that balance sheet. Because in a high-rate environment, growth narratives can collapse overnight if the debt ceiling caves in. And if we look closely, there are absolutely cracks in the armor. Let's go back to the debt, and let's look at the absolute total number, not just the net unsecured portion that the bulls like to quote. Total debt actually rose to a monstrous $172.5 billion from $158.2 billion. This is the glaring crack in the foundation. The $130 billion is just the unsecured portion, but if you look at the total monstrous pile of all liabilities, it is sitting at $172.5 billion. Yes, they have cash flow, but they are servicing an absolute mountain of debt in an era where interest rates are totally unforgiving.
You have to ask yourself, is the cash flow growing fast enough to outpace the sheer cost of holding this much leverage? Let's drill right into the leverage ratios because that tells the real story of the pressure they're under. Verizon's net unsecured debt to EBITDA ratio has climbed from 2.2x to 2.6x. To put that simply, it means it would take them 2.6 years of throwing every single penny of operating profit at their debt just to pay it off. Management claims they are going to hit their 2.0x to 2.25x target by 2027, but how? They're simultaneously planning to spend $16 billion to $16.5 billion on capital expenditures to build out their fiber and 5G networks this year alone. They are burning cash to build the network, paying out a massive dividend, and trying to magically pay down debt all at the same time. That is a very, very tight tightrope to walk.
And what about those supposedly record-breaking 55,000 phone net adds we celebrated earlier? Well, let's bring in Craig Moffett, a highly respected analyst from MoffettNathanson. He completely challenged this bullish narrative. He pointed out that while adding 55K lines is great, it actually came with a sizable loss of accounts. Think about what that means in the real world for a second. They might be successfully convincing an existing customer to add an iPad or a smartwatch to their family plan, which technically counts as a quote-unquote net add, but they are actually losing entire households to competitors like AT&T or T-Mobile. The total customer base is shrinking, even if the line count is technically up. That's a massive red flag.
Moffett continues the assault right here, and this is absolutely critical. He notes that Verizon's ARPA, which stands for average revenue per account, actually declined. Now, Verizon management blames this drop on the credits they had to issue for the massive January network outage. But Moffett rightly points out that if you are bleeding revenue per account, your core business is decaying. Sharply lower average revenue runs completely counter to the narrative that Verizon is successfully reducing their promotional activity. You simply cannot cut your way to greatness. If your core organic revenue per user is falling, cost-cutting will only buy you so much time before the floor completely gives out. All right, let's put these two sides right up against each other so you can see the full picture. On one side, we have record 38.9% EBITDA margins, the highest EPS growth in 4 years, and the first positive Q1 phone ads since 2013. The operational engine is undeniably firing on all cylinders and throwing off $21.5 billion in guided free cash flow. But on the exact other side of the ledger, you have the incredible weight of $130 billion in net unsecured debt, leverage ratios that are creeping up to 2.6x, and underlying account-level weakness with revenue per account slipping. The big risk here is that if a recession hits, or if subscriber growth turns negative again, that debt load will completely crush the stock price, no matter how good the current dividend looks today. And that brings us squarely to the iron financial verdict. We have synthesized the earnings call, ripped through the 8K filings, and digested the third-party analyst notes. It is time to shift from debate to providing our definitive, actionable takeaways. What is the ultimate read on CEO Dan Schulman's strategy? And more importantly, what should you actually do with your capital right now? First, let's reiterate the undeniable, tangible benefits to the shareholder. You are getting paid handsomely to wait for the debt to come down. A 6.1% yield equates to a very real 70 cents and 75 cents quarterly payout per share. But it's not just the dividend protecting you here. Verizon has a massive $25 billion share buyback plan in place, and they have already repurchased $2.5 billion in shares in Q1 alone. By shrinking the float, meaning reducing the total number of shares available on the open market, they artificially support the share price and boost future earnings per share. In a sideways volatile market, having the company itself acting as a guaranteed buyer of $25 billion worth of stock provides a massive, ironclad floor under the share price. Now, any skeptic has to concede that the cash flow is very real. You cannot fake $3.8 billion in free cash flow in a single quarter. But you have to aggressively balance that solid foundation against the strict timeline required to organically grow revenue and actually pay down that $130.1 billion in net unsecured debt. If interest rates stay higher for longer, refinancing any of that debt becomes incredibly painful. Never forget, this is not a high-growth, nimble tech stock. They lay massive physical fiber cables and build physical steel cell towers across the country, just like a water or power company. This is a heavy industrial utility play masquerading as a tech company, requiring immense, constant capital just to survive. Which brings us to our no-nonsense bottom-line takeaway. Verizon is not a value trap. The cash generation is simply too strong to label it a trap right now. However, it absolutely requires your patience and your vigilance. The iron financial positioning is this.
If you hold it, collect the 6.1% dividend as a solid income foundation for your portfolio, but do not fall asleep at the wheel. You need to aggressively monitor their 2027 leverage target. If they slip from that 2.0x to 2.25x goal, the armor is breaking. And you must track actual account retention, not just newly added lines or watches. If they keep losing total households to the competition, the cash flow drops, and that massive dividend eventually becomes mathematically unsustainable. We want to leave you with a final, provocative question to stress test your own portfolio strategy. Look closely at your current holdings. Does Verizon's 6.1% yield forge a solid enough foundation for your specific income needs to successfully offset the immense, looming $130 billion weight of its debt? Do you have the stomach for Verizon's heavy lifting over the next 3 years? Run the numbers for yourself, stay highly disciplined, and keep forging a stronger portfolio. Thanks for tuning into this explainer.
Disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.